I never thought I'd find myself tangled in the world of high finance, but here I am, standing on the edge of a financial abyss that most people don't even know exists. You see, there's this market worth 600 trillion pounds. Yes, with a T. And no, it's not the national debt or the combined wealth of the Queen's entire family. It's something far more dangerous. It's called the derivatives market, a financial beast so vast and complex that it nearly annihilated the global economy back in 2008. And guess what? It's now 10 times bigger. If you thought 2008 was bad, brace yourself. This time, it's not just bad, it's apocalyptic. I remember sitting in a small cafe in Canterbury when I first stumbled onto this nightmare. The market was like a shadowy underground club where bankers and hedge fund managers whispered in code, trading contracts nobody outside their circle could understand. Warren Buffett, yes, the Oracle of Omaha, once called derivatives financial weapons of mass destruction. He wasn't joking. These things triggered the collapse of Lehman Brothers, the bailout of the insurance giant AIG, and nearly destroyed the entire banking system. Yet, instead of disarming the bomb, the world decided to build a bigger one. Imagine this. The global economy is roughly 100 trillion, but the derivatives market today is over 600 trillion. It's like building a skyscraper on a foundation made of Jenga blocks. One wrong move, and everything collapses. When that happens, and it will, there won't be a single pound left anywhere to bail out the wreckage. But what exactly are these derivatives? At first, I thought they were some kind of exotic fruit or a new type of British tea blend. Turns out, a derivative is a financial contract whose value depends on an underlying asset. Sounds simple, right? But the asset could be anything, a stock, a bond, even the weather. Yes, you can actually bet on whether it's going to rain in London next week without owning a single umbrella. It's like buying insurance on your neighbor's house burning down. You don't own the house, you just collect if it burns. Morbid, but true. There are different types: futures, options, swaps, and forwards. Think of futures as betting on the price of wheat without actually buying a sack of it. Options give you the right, but not the obligation, to buy or sell something at a set price. Swaps are like exchanging fixed interest payments for variable ones. Imagine swapping your boring old tea for a cup of unpredictable coffee. And forwards are customized deals between two parties. Farmers use futures to protect themselves from price drops. Airlines hedge against soaring fuel costs with derivatives. Sounds sensible, right? But the real party is thrown by banks, who use these contracts to make leveraged bets on interest rates, credit risks, and currency swings. And here's the kicker. Leverage means they're playing with borrowed money, sometimes 100 times their own stake. It's like betting your house on a game of poker where you don't even know all the cards. Back in 2008, when the market was a mere 60 trillion, it took 29 trillion in bailouts just to stop the crash. Now, with a market 10 times that size, the stakes have never been higher. The system is a tangled web of bets on bets on bets, so complex that even the people who create these contracts can't predict what will happen if the market turns against them. I'll take you through the chaos that brought us here, starting with the fall of Lehman Brothers, the near collapse of AIG, and the absurd political dance that followed. But first, picture this. A city skyline at dusk, the glass towers gleaming, reflecting a calm before the storm. Inside, men in tailored suits and polished shoes shuffle papers worth trillions, oblivious to the ticking time bomb beneath their feet. One wrong move, one failed bet, and the whole thing could blow sky high. And trust me, the next explosion is already brewing. I remember the moment I really started to grasp how deep this rabbit hole went. It was a rainy afternoon in Brighton, and I found myself in a polished yet oddly cold conference room at a local financial seminar. The speaker was a sharp, middle-aged man named Richard Lawson, slicked back hair, navy suit, and a tie so tight I half expected him to pass out mid-sentence. He began explaining derivatives with the kind of enthusiasm usually reserved for football or fish and chips. But beneath his polished exterior, I sensed a hint of unease. He told us about Lehman Brothers, the fourth largest investment bank in America back in 2008. Picture this: a giant on paper boasting assets of $480 billion and liabilities just slightly less. To the outside world, they looked solvent, stable, but hidden in the footnotes was a staggering $26 trillion exposure to derivatives. And I don't mean assets they owned. I mean bets they'd made with banks around the globe, bets on interest rates, mortgage-backed securities, and credit risks. It's like Lehman was walking a tightrope over the Thames, blindfolded, juggling chainsaws. When the housing market started to tank, those bets turned sour. Lehman's trading partners suddenly demanded more collateral, more cash to back those bets. But Lehman didn't have it. Imagine trying to pay your bar tab with monopoly money. By September 2008, no one wanted to trade with Lehman. They assumed it was insolvent. And just like that, the giant fell. The collapse wasn't just a bad day at the office. Lehman's bankruptcy triggered a chain reaction. Every contract it had entered defaulted. Banks, pension funds, insurance companies suddenly found themselves exposed to billions in losses they never expected. A mid-sized pension fund in Nottingham that had swapped interest rate contracts with Lehman was suddenly left holding the bag. A European bank that had bought insurance against defaults from Lehman found itself unprotected. The dominoes began to fall. And then there was AIG, the insurance behemoth with assets over $700 billion, their financial products division, had sold credit default swaps, essentially insurance against bond defaults, on hundreds of billions of pounds in mortgage-backed securities. They collected premiums, confident the housing market would never crash nationwide. Spoiler alert, it did. When the housing bubble burst, AIG owed tens of billions it simply didn't have. Their credit rating plummeted, triggering clauses that demanded immediate collateral. They couldn't pay up. The UK government, along with the US Federal Reserve, had to step in with an emergency loan of $65 billion. And that was just the beginning. Over the next several months, AIG would receive nearly $140 billion in bailouts, the largest rescue in history. But here's the kicker. That wasn't a bailout of AIG alone. It was a lifeline for the banks and investors who'd bought these credit default swaps from AIG. Goldman Sachs, Barclays, and a host of other big names received billions to cover their losses. The government funneled money through AIG to keep the entire financial system afloat. It's like a twisted game of musical chairs. When the music stopped, the taxpayers were left standing without a seat. And that's when it hit me. These derivatives weren't just complicated contracts. They were ticking time bombs, transferring risk from one institution to another, spreading like a virus through the financial bloodstream. Richard paused, adjusted his tie, and with a dry smile said, "You see, the real problem is no one knows who owes what to whom anymore. It's a financial maze with no exit, and the walls keep closing in." The room fell silent. Even the seasoned investors looked uneasy. I wanted to ask, so what happens next? But deep down, I already knew the answer. When this beast wakes again, no one will be ready. The next morning, I found myself wandering the narrow cobbled streets of Rye, a quaint English town that felt worlds away from the chaos brewing in the financial capitals. But the more I learned, the more I realized that no corner of the world was safe from what was coming. Derivatives weren't just a Wall Street or Canary Wharf problem. They were a global spider web, and I was staring at the center of the storm. I met Emily, a sharp investment analyst with a penchant for vintage silk scarves and ruby red lipstick that somehow made her look both fierce and approachable. She wore a tailored charcoal skirt suit that hugged her curves just enough to turn heads in the boardroom, paired with classic black stilettos clicking confidently on the pavement. Emily was one of those people who could make spreadsheets sound sexy, though, let's be honest, that's no easy feat. She explained to me how banks weren't just using derivatives to hedge risk anymore. They were using them to place massive bets, leveraged bets, on everything from interest rates to foreign currencies. Imagine a game of poker where you're not just betting with your chips, but with your neighbor's house, your boss's car, and the pub down the street. That's the world these banks operate in. Take J.P. Morgan Chase, for example. This titan holds about $43 trillion in derivatives exposure. To put that in perspective, their total assets are just over $3 trillion, and their equity capital sits around $250 billion. It's like trying to balance a mountain of teacups on a single teaspoon. If just a tiny fraction of those bets go wrong, the whole thing could shatter spectacularly. Emily leaned in, her voice dropping just a notch. And here's the kicker. These derivatives aren't simple contracts anymore. They're derivatives of derivatives. Like Inception, but with money. You can buy an option on a credit default swap, which is itself a bet on a bond defaulting. It's a pyramid of risk, and nobody really knows who's on top or bottom. I couldn't help but joke. So it's like financial Russian roulette, but with more paperwork and less chance of winning a prize. She smiled, but it was a grim kind of smile. Exactly. And when one bank falls, it drags the others down like a row of dominoes. The system's so interconnected, it's impossible to predict where the next crack will appear. Emily told me about the 2015 reforms, Dodd-Frank in the US and MiFID II in Europe, that were supposed to bring transparency and reduce risk. But the reality was more like putting a Band-Aid on a sinking ship. Only a small fraction of derivatives are traded on regulated exchanges. Most remain over-the-counter contracts, private and opaque, like secret deals made in shadowy backrooms. I pictured a darkened trading floor in the city of London, screens flickering with endless streams of numbers, traders shouting into phones, and suits moving like sharks in a feeding frenzy. The stakes were astronomical, but the rules were murky at best. Emily's phone buzzed. She glanced at it, a flicker of worry crossing her face. Interest rates have been rising fast these past few years. Banks took huge positions when rates were near zero, betting they'd stay there. Now, with the Bank of England hiking rates to tame inflation, those bets are turning sour. It's like watching a slow-motion train wreck. I frowned. So the financial crisis isn't just a memory? It's a brewing storm? She nodded. And the worst part, the losses are hidden. Banks use accounting tricks to avoid marking these positions to market. It's like pretending the Titanic's fine while the iceberg's already inside the hull. I sipped my coffee, the bitterness matching the gravity of what I'd just heard. The calm streets of Rye suddenly felt fragile, like the eye of a hurricane about to unleash chaos. Emily looked out the window, her voice barely above a whisper. When this blows, it won't be like 2008. It'll be worse. Much worse. I still remember that evening in Oxford, sitting in a dimly lit jazz bar where the smoky air mingled with the soft notes of a saxophone. Across from me was James, a retired banker with a weathered face and a penchant for tweed jackets that made him look like he'd just stepped out of a Bronte novel. He had a crooked smile and eyes that seemed to carry the weight of every financial storm he'd witnessed. James wasn't one for small talk. He poured us both a glass of single malt and leaned in. You want to understand why derivatives are a ticking time bomb, lad? It's all about the dominoes nobody sees. He started telling me about the mechanics behind these contracts, the hidden risks that lurked beneath the surface of what looked like neat balance sheets. Take interest rate swaps, for example, he said, swirling his drink. Banks use these to swap fixed rate payments for variable ones, or vice versa. Sounds harmless, right? But when interest rates rise or fall sharply, The value of these contracts can swing wildly. He reached into his pocket and pulled out a folded piece of paper covered in scribbles, his own crude diagram of how these swaps interconnect banks across continents. Imagine J.P. Morgan swaps with Barclays, who swaps with HSBC, who swaps with Deutsche Bank in Frankfurt, who swaps back with J.P. Morgan. It's a tangled web, a circle of bets that cancel each other out, until one player can't pay up. James chuckled dryly. When Lehman went under, that circle broke. Suddenly, banks thought, if I can't trust you, who can I trust? And credit markets froze, faster than you can say, economic meltdown. He took a sip and then dropped a bombshell. Now the exposure is 10 times bigger, and those circles have grown into a labyrinth. The sheer scale of these contracts is mind-boggling. J.P. Morgan alone has exposure worth over 43 trillion. That's more than 10 times the UK's GDP. I tried to picture it. Buildings of money piled so high they'd scrape the clouds, held together by paper contracts and promises. But how do they manage that risk? Surely they must have safeguards, I asked. James snorted. Safeguards? The banks use fancy risk models that assume markets behave normally, like markets are polite and predictable. But markets are more like a pub brawl on a Friday night, loud, messy, and full of unexpected punches. When things go sideways, those models are about as useful as an umbrella in a hurricane. He paused, looking me straight in the eyes. And the regulators. They put rules in place after 2008, moving some trades onto clearinghouses to reduce risk. But most derivatives are still traded over the counter in private. It's like telling everyone to drive safely, but leaving the highways unmonitored. I sipped my drink, the jazz music swirling around us, feeling the weight of his words settle in. James leaned back and added, the real kicker is leverage. Banks only have to put up a fraction of the contract's value as collateral, sometimes as little as 1%. That means a 1% move against them can wipe out everything they've posted. A 2% move, and they're in the red. I joked. Sounds like playing poker with someone else's chips. What could possibly go wrong? James laughed, a low, gravelly sound. Exactly. And when the market moves fast, margin calls come flying. Banks scramble to find cash, selling assets, pushing prices down further, a vicious cycle. He shook his head. The system's a powder keg, and the fuse is burning. As the saxophone played its final note, I realized this wasn't just a story about numbers and contracts. It was about people, power, and the fragile trust holding the entire financial world together. And somewhere, deep inside this maze of bets and promises, the next crisis was already waiting to explode. The next day, I found myself wandering through the quiet streets of Bath, the Roman baths glistening under a pale winter sun, ancient stones whispering tales of empires long gone. But the empire that worried me most wasn't ancient. It was the modern financial system, teetering on the edge of collapse. I arranged to meet Sarah, a risk manager at a mid-sized hedge fund, in a cozy tea shop adorned with lace curtains and the faint scent of Earl Grey. Sarah was the kind of woman who could command a room without raising her voice. She wore a sleek emerald green dress that hugged her figure just enough to turn heads without breaking any boardroom dress codes. Her silver necklace caught the light every time she spoke, a subtle reminder that elegance and intelligence often walk hand in hand. Over steaming cups of tea, she explained how the derivatives market had ballooned to over 600 trillion pounds. Notional value, mind you, which means the face value of all the contracts combined. But the actual money at risk? That was a fraction of that. And therein lay the danger. Think of it like this, Sarah said, stirring her tea thoughtfully. If you own a house worth $300,000 and you insure it for that amount, you're covered. But if you sell insurance policies on 10 houses, each worth $300,000, Without owning any of them, you're exposed to a risk of $3 million. Now multiply that by hundreds of banks and investors doing the same, and the math gets scary. She told me about credit default swaps, those infamous contracts that were supposed to insure against bond defaults, but became gambling chips for investors who didn't even own the bonds. It's like betting on your mate losing a game of darts, even though you're not playing. If he loses, you cash in. If he wins, you lose your bet. Sarah's eyes darkened as she recalled the 2008 crisis. AIG sold these swaps without setting aside enough cash to pay out if things went south. When the housing market collapsed, AIG owed more than it could pay. The government had to step in with a bailout of nearly $140 billion. But that bailout wasn't just for AIG, it was for every bank that bought those swaps. I shifted in my chair, feeling the weight of the story settle in. So the taxpayers ended up footing the bill for risky bets they never agreed to. She nodded. Exactly. And the problem is the derivatives market didn't shrink after that. It grew tenfold. Banks argued these contracts were essential for managing risk and providing liquidity. Regulators believed them, or maybe they were just worn out by the constant lobbying. Sarah took a sip from her cup and continued. The biggest chunk of derivatives now are interest rate contracts, over $500 trillion worth. Banks use them to hedge against changes in interest rates, but they also speculate. The problem is, interest rates have been rising rapidly since 2021, from near zero to over 5%. That's the fastest hike in decades. Her voice lowered. Every time rates jump, some banks lose money on these contracts. But thanks to accounting rules, many don't have to mark these losses to market immediately. It's like hiding a leak under the carpet until the whole floor collapses. I stared out the window at the Georgian terraces, wondering how many of those elegant homes were owned by people unknowingly tied to this invisible storm. Sarah leaned forward, her gaze intense. And it's not just interest rates. Commercial real estate is another ticking bomb. Over $2 trillion in commercial mortgages need refinancing soon, at much higher rates. Defaults on these loans will trigger payouts on credit default swaps tied to commercial property. I laughed bitterly. So, we're sitting on a financial powder keg, and someone just lit the fuse with rising rates. Sarah smiled sadly. That's one way to put it. The difference is, this time the fuse is shorter, the explosives bigger, and the fire department's out of water. A week later, I found myself stepping into the grand halls of the Bank of England, its towering columns a reminder of centuries of financial power and tradition. But behind those stately walls, I learned, the calm facade barely concealed the storm brewing beneath. I was there to meet David, a senior economist with a penchant for bow ties and a mischievous twinkle in his eye that suggested he enjoyed rattling cages. He wore a crisp navy suit, polished brogues, and carried a leather briefcase that looked like it had survived more crises than I could count. David wasted no time. You want to know why the next derivatives crisis could be worse than 2008? It boils down to 3 words: leverage, complexity, and interconnectedness. He paced slowly, hands clasped behind his back. Leverage means banks are betting with borrowed money, sometimes 100 times their capital. That's like playing a game of Jenga with skyscraper-sized blocks. One wrong move and the whole tower collapses. He pulled out a chart showing the massive growth of derivatives since 2008. Back then, the market was around 60 trillion. Now it's over 600 trillion, 10 times bigger, and yet the safeguards remain weak. David's voice dropped as he spoke of complexity. Derivatives have evolved into contracts layered on contracts, options on swaps, swaps on indexes of swaps. It's financial inception. Even the traders who create these instruments can't fully predict how they'll behave when markets go haywire. I raised an eyebrow. So it's like building a house of cards in a hurricane? Exactly. He smiled grimly. And interconnectedness, that's the web binding the biggest banks, J.P. Morgan, Barclays, HSBC, and Goldman Sachs. Together, they hold nearly 90% of all derivative exposure in the UK and US. They're like a quartet playing a high-stakes symphony where a single missed note could bring the whole performance crashing down. David's phone buzzed. He glanced at it, then looked up sharply. Speaking of, there's been a sudden spike in credit default swaps related to a major European bank. Investors are spooked. He leaned in, voice low. If a big bank in Europe fails, it won't stay a European problem. Thanks to derivatives, the shockwaves will hit London, New York, and beyond, quickly and brutally. I asked, but can't central banks step in like last time? David shook his head. The problem is scale. In 2008, governments committed roughly $20 trillion globally to stabilize markets. That was about 40% of global GDP. Now the potential losses could exceed $60 trillion. There's simply no money left to bail out the system without destroying currencies. He sighed. Printing more money risks hyperinflation. Taxpayers are already exhausted. Political will to rescue banks is evaporating. The too big to fail doctrine has morphed into too big to save. David paused, eyes intense. The next crisis won't creep up slowly. It will explode overnight. Banks will freeze, credit will vanish, and everyday people will feel the shock in their wallets. I swallowed hard, the weight of his words settling like a stone in my gut. Outside, the city bustled as if nothing was wrong, but inside that grand building, the countdown was ticking louder than ever. As I stood to leave, David's parting words echoed. We're sitting on a financial time bomb, and the fuse has already been lit. A few days later, I found myself in a sleek, glass-walled office overlooking the Thames in Canary Wharf. The city's modern skyline glittered under the midday sun, but inside, the atmosphere was tense. I was meeting Claire, a former trader turned whistleblower whose sharp blue eyes and confident stride contrasted with the nervous energy in the room. Claire wore a tailored black pencil skirt and a silk blouse that hinted at rebellion beneath corporate formality. Her heels clicked sharply as she paced, the kind of sound that demands attention. Around her wrist, a delicate silver bracelet caught the light, an understated reminder that even in the cutthroat world of finance, style mattered. She leaned forward, voice low but urgent. You want the real story behind derivatives? It's not just about numbers or markets. It's about secrecy and shadows. Claire explained how the biggest banks used over-the-counter derivatives, contracts negotiated privately between parties, to dodge regulatory oversight. These deals are customized, opaque, and almost impossible to track. It's like a secret club where the rules are made up as they go along. She pulled out a folder filled with leaked documents and whispered, "Here's the proof. Banks hiding massive risks off their balance sheets, using complex structures designed to confuse auditors and regulators alike." I glanced over the papers, seeing charts with dizzying figures, footnotes that twisted liability into loopholes, and contracts so complicated even lawyers hesitated. So they're gaming the system? Claire nodded grimly. Exactly, and the stakes couldn't be higher. Interest rate derivatives alone account for over $500 trillion of exposure. When the Bank of England started hiking rates, many of these bets turned sour, but banks delayed marking those losses to market. It's a house of cards built on denial. Her voice dropped to a whisper. And it's not just interest rates. Currency derivatives, over $100 trillion, are vulnerable too. The dollar's grip on the world economy is slipping. Countries like China and Russia are trading oil and goods in their own currencies. If the dollar weakens suddenly, those currency bets could unravel overnight. Claire's eyes flashed. When one bank fails to meet its derivative obligations, it triggers margin calls and forced asset sales. Other banks get hit. The clearinghouses that guarantee trades face losses too. It's a chain reaction. I asked, "Is there any way to stop it?" She shook her head. The system is too big, too complex, and too interconnected. Regulators are overwhelmed, and banks are too powerful. The next crisis won't be a surprise. It's a matter of when, not if. Claire paused, then added with a half smile, "And when it hits, it won't just be numbers on screens. People will lose jobs, pensions will vanish, and everyday life will grind to a halt." Her words hung heavy in the air as the city hummed below, oblivious to the ticking time bomb hidden beneath its glittering surface. A few nights later, I found myself in a dimly lit pub, nestled in the heart of Manchester, the kind of place where the wood-paneled walls have soaked up decades of laughter, arguments, and the clink of pints. The air was thick with the smell of malt and anticipation, and at the corner table sat Tom, a veteran financial journalist with a reputation for digging where others dared not. Tom was the kind of bloke you'd trust to have your back in a bar fight or a market crash. Rugged, with a salt and pepper beard and eyes that missed nothing. He wore a worn leather jacket over a casual shirt, and his hands were wrapped around a half-empty pint of bitter. He leaned in, voice low but deliberate. "You want to know why this derivatives mess is worse than some boardroom scandal? It's because it's global, and it's already starting to unravel." Tom pulled out his tablet, scrolling through headlines. A major German bank facing a surge in credit default swap spreads, Chinese property developers defaulting on billions, and whispers of sovereign debt troubles in Tokyo. Europe's banks are stressed. Credit Suisse collapsed, swallowed by UBS in a government-forced merger. Deutsche Bank's derivatives exposure is staggering, over 35 trillion. If one of these giants falters, it'll hit London and Wall Street like a tsunami. He shook his head. China's real estate market is a disaster zone. Developers like Evergrande and Country Garden have defaulted on hundreds of billions in debt. Local governments are drowning in hidden liabilities, and the credit default swaps tied to their debt could trigger massive payouts. Tom's fingers drummed on the table. And Japan? With government debt over 260% of GDP, it's a powder keg. If investors lose faith, the yen could collapse, triggering a cascade of losses on sovereign credit derivatives worldwide. He looked up, eyes sharp. The problem is, these crises don't happen in isolation. Thanks to derivatives, a default in Shanghai or a banking crisis in Frankfurt instantly spreads to New York and London. It's a tightly woven web. I asked, "But what about the regulators? Aren't they watching?" Tom snorted. "They're overwhelmed. The sheer size and complexity make it impossible to track who owes what to whom. When Lehman collapsed, it took months to unravel their derivative contracts. Now, with exposures 10 times larger, a multi-bank collapse would be chaos beyond comprehension." He took a long sip from his pint. "And here's the kicker. Governments don't have the firepower to bail everyone out. The UK's national debt is already sky high. The US is drowning in its own obligations. Central banks printing money risks runaway inflation." He shrugged. "Politically, the public won't stand for another bailout either. The anger after 2008 was just a warm-up. This time it'll be a full-blown revolt." I looked around the pub, filled with locals chatting about football and the weather, blissfully unaware that the financial world was on the brink. Tom smiled wryly. "The question isn't if the next crisis will come. It's when and how bad it'll be. And whatever happens, it's going to be a bumpy ride for all of us." Late one evening, I found myself walking the misty streets of Edinburgh, the ancient city cloaked in shadows and silence. The castle loomed above, a stoic reminder of history's relentless march. But tonight, History felt like it was about to repeat itself. Only this time the stakes were far higher. I met with Robert, a former central banker turned financial consultant, whose sharp features and salt and pepper hair gave him the look of a man who had seen too much, yet refused to look away. He wore a dark overcoat, and his piercing eyes seemed to cut through the fog like a lighthouse beam. Robert didn't waste time. "The derivatives market is a beast that's grown beyond control," he said, voice steady but grave. "Back in 2008, governments had the will and resources to step in. Now, the cupboard's bare." He explained how sovereign debt crises were the darkest threat looming on the horizon. Countries like Japan and some European nations carry debts so immense that any shock could trigger defaults. When governments stumble, their bonds lose value, and the derivatives tied to those bonds explode. Robert's gaze hardened. "It's a triple threat: credit risk, currency risk, and interest rate risk all converging. Imagine the yen plunging while bond yields spike and investors panic. The fallout would be global and instantaneous." He pulled out a worn notebook filled with scribbles and charts. "China's local government debt is another time bomb, much of it hidden in off-balance sheet vehicles. When defaults mount, foreign banks and funds holding derivative contracts on that debt face huge losses." I asked, "Is there any way to contain this? To prevent a domino effect?" Robert sighed. "The problem is the network of contracts. They're circular and intertwined. J.P. Morgan hedges with Barclays, Barclays with HSBC, HSBC with Deutsche Bank, and so on. On paper it looks balanced. In reality it's a house of cards." He added, "When one falls, the rest feel the shock waves. Clearinghouses can only do so much. Most trades are still over-the-counter outside central clearing. No one really knows who's exposed to what until it's too late." Robert's voice dropped to a whisper. "The scale is unprecedented. If 10% of the derivatives market defaults, that's 60 trillion in losses. There's no bailout big enough. The financial system would unravel." I swallowed hard, the weight of his words pressing down. "What happens then?" He looked me in the eye. "Pension funds collapse, credit freezes, businesses fail, people lose their savings, governments fall, social unrest erupts. It's not just economics, it's a societal crisis." As the fog thickened around us, Robert's final warning lingered in the cold night air. "We're on the edge of a precipice. One wrong step, and everything falls into the abyss." The dawn was breaking over Liverpool as I sat alone on the waterfront, the cold breeze carrying the distant hum of ships and the faint cries of seagulls. The city's historic docks, once the heartbeat of global trade, now felt like a silent witness to a world on the brink of chaos. I reflected on everything I'd learned: the sprawling derivatives market, the tangled webs of bets stacked sky-high, the fragile trust binding colossal banks across continents. The truth was clear. The system was a powder keg waiting for a spark, and that spark could come from anywhere: an unexpected interest rate shock, a major real estate default, a European bank's collapse, or a sudden plunge in a currency long considered stable. What terrified me most was the speed. Unlike the slow burn of past recessions, this crisis would explode in days, maybe hours. Markets would freeze, credit would vanish, and the lifeblood of the economy, money, would stop flowing. Bank accounts could be frozen, pensions wiped out, and everyday people left powerless. Governments and central banks would scramble, promising emergency measures and bailouts, but the scale would be beyond their grasp. Printing money would unleash inflationary storms, and political unrest would grip nations already frayed by inequality and distrust. As I watched the sun rise over the Mersey, I realized this wasn't just a financial crisis. It was a reckoning, a test of resilience for governments, institutions, and individuals alike. And yet, amid the looming disaster, a question gnawed at me. Who, if anyone, truly controls this beast? If the biggest banks stumble, if regulators fail, if trust shatters, what comes next? The derivatives market was a labyrinth with no clear exit, a puzzle with missing pieces. Somewhere in the shadows, a secret waited, one that could either save us or doom us all. I stood up, the cold biting at my face, and made a silent vow to uncover that secret before the next explosion. Because when the next financial earthquake hits, it won't just reshape markets, it will reshape the world itself. And the countdown has already begun.